Not sure if you've seen the recent headlines, but it appears mortgage rates have gone over 7% again. This is something very similar to what happened last July or August when we first got here. We're going to have a conversation with Matt, the mortgage guy, and see what he thinks is going on. I've already talked to many different real estate agents about their market, but wow, Matt, we are above 7%, and there were mortgage experts calling for us to be at 5% in May. And just in case you need to know, 7 is more than 5.
That escalated quickly. And so, yeah, it's always funny looking back in retrospect. Our buddy Ryan Lundquist has some funny graphs of like, hey bro, all these bro guesses on where rates are going to go. But you know, I know better than anybody that I don't know what economic factors are going to influence rates in Q3 and Q4. We've got data that we've got today that we can guess and we can have educated guesses on, but none of us know. None of us knew, you know, about banking crisis and big blocks of mortgage-backed securities being sold and the debt ceiling and what's going to happen with employment in the economy. And so second consecutive week of decline on mortgage applications, which shouldn't be a surprise to anybody. When mortgage rates go higher, mortgage demand goes down. And I think it's a good conversation to have between a couple of people who I think me and you both try to keep our finger on the pulse of housing and real estate and how different things affect it. No doubt, demand is lessened, and the data shows it when mortgage rates go up. What I think is going to happen, and I'll speak to a market like Sacramento, and I have concrete examples because I'm in it all day, every day.
Right.
A duplex at the, you know, 550 price point in Sacramento is a hot commodity for investors, whether they're going to own or occupy one side or buy it. I had a client put in an offer 4 weeks ago, and it was one of 35 offers.
Oh, jeez.
I had a client put in an offer on Sunday, you know, a la a few days ago, and I called the agent and I said, hey, listen, I'm calling like I always do, full file, well-qualified client, an engineer. But just out of curiosity, how many offers did you get? I'm trying to get information because I'm genuinely curious. I like real estate. 7. So rates go up 0.5 point in a 4-week period. And, you know, this isn't perfect math and it's not every deal, but the amount of offers you're getting is going to decrease. So if rates stay this high for long enough, probably a good thing for the housing market. And you could see, every market's different, you know, and this is the funny part about it, Mike, is it always takes the end consumer so long to catch up to what's happening. They're going to be like, I'm ready for my 30 offers. I'm ready for my 15 offers. And then when they only get 1 or 2, oh my gosh. And it's not above ask. Now it's $490 on my $500,000 listing. This is a good thing for price, in my opinion, because at low 6s, we still had a little bit of imbalance where we were getting 7 or 8 offers. So a $500,000 listing in Sacramento was going to sell for $530, and it was competitive. This is going to pull some of that competition out, some of the demand out, and it's going to make it, you know, an easier time for the buyers who are buying, albeit they've got to pay a slightly higher rate. I think it's a better experience for them. I think they're more apt to get a deal. And so I personally think it's a good thing.
Yeah, it's going to be really interesting because, again, I'm a data geek at heart. And what not a lot of people realize is if you take, you know, mortgage rates last July and August to today, they're roughly the same. But 2 things are very different. Last July and August, people's memories were 4%. So the 7% was a shock. Today, we've been bouncing around 6.5. So 7% certainly is not fun, but it's not a shock. Second, and probably more important, and again, not many people do the work like we do. Inventory last July and August to inventory today at the beginning, let's call it the beginning of June, for most of the country is down more than 30%. In some high cost areas like Seattle, San Diego, I think even Sacramento, inventory's down 40%. And when you're an economist like I am, and you know the supply demand curve, if you generally move the supply curve down 40%, but you only move the demand curve down 10%, still a problem. And I think that's what's going to happen, because again, the memory of last July and August. I mean, I have agents, I have receipts, right? I have videos. They're like, Michael, I have nobody at my entire open house. The entire weekend, nobody showed up. Now I talk to people like, no, still, maybe a little slower, still going, still getting offers. Now, again, below the median, first time home buyer, all that stuff. So I don't think 7% is the shock. I think 8% would be the shock this time. What do you think of all that?
Yeah, I think you're right. I had this conversation on Monday. I had a couple of guys who've got a really good finger on the pulse because they're flipping multiple homes in the Sacramento market. And they made the point that you made that, buyers are coming to grips with higher interest rates. If I look back on a chart that I've got up, we're coming up on a year. Last June, we were above 6%. Then it comes down in August and we're back almost, low fives. And then by September, we're up above 6 again. And then we peak above 7. But we've been in this 6% range for a year. A year is a lot of time for buyers to go, okay, I'm used to looking at the higher payments. I'm used to a rate that doesn't look anything like what I was looking at in 2021. And so they've come to grips with that. And, so it's to your point, going to take some of the demand out, but 7%'s not a big enough sticker shock or a big enough rate to pull out the same 40% demand that's been taken, the 40% number that's been taken out of the supply side.
Right. And again, it's all consumer psychology, right? The first time something dramatic occurs, it's meaningful. The second time, it's just not as meaningful. That's what's happening now. But it's going to be interesting. I actually go back to the article in Fortune that I was featured in. I actually think 7% mortgage rate will hurt sellers more than buyers. And what do I mean by that? The part of the market that's not operating is the move-up buyer. The move-up buyers, generally speaking, have optionality. And if you're going to be trading in a house that's a little bit too small, that's a little too old, that's in the wrong school district for the one that is, not only you're paying a higher sticker price, but now your mortgage rate's more than 100% higher, maybe 150% higher. That optionality goes out the window. So I actually think it's weird that a 7% mortgage rate is going to hurt supply more than it hurts demand. Because again, we've been here before on the demand side. What do you think of that?
Yeah, I think you're right. And part of the conversation I had Monday was buyers are still buying. When you go from 6 to 7, they just say, okay, I don't need the bells and whistles. I still want to buy a house. And the funny part is these guys flipping homes understand that. And so they're not doing expansive remodels, trying to break the record in the neighborhood. It's smart, right? They've listened to the consumer and they've said, okay, if we do everything, we're going to have to get 550 to make a profit. But if we do the bare minimum, a buyer says, listen, here's the payment I want. Here's what I can afford. I don't need granite countertops and I don't need both bathrooms remodeled. Just give me the basic plan at this price and I'm still going to buy. And for sellers, to your point, and next week we'll go over some Logan Matashami stuff because we had an hour interview with them at U Mortgage. The 10 years already 13 to 15 years. Someone's staying in the same house. And so 7% is going to make it to where it's not even, a quick glance. Nope, not going to do it. Not going to sell.
Not going to do it. Not going to sell. Stay in put. Yeah, folks, the housing market is broken. You've heard me saying this now for a year or so. The housing market, Fed broke housing. I think transactions will be sub 4.5 million for the next year and a half at least. So yeah, again, this is going to be very interesting times. If people wanted to reach out to you and see what's what for them and their mortgage needs, what should they do?
Sure. Go to greatmortgagebroker.com. That's the best way. Quick little form. Get in contact with our team. We've got loan officers in 48 different states. So greatmortgagebroker.com.
Thank you, buddy. I appreciate you.
Thanks, Mike.